let's see. Spencer's doing a budgeting workshop for us on the 28th. That'll be really good. I've actually gone to that and I took my family and I was like, everybody sit down, we're gonna learn how to budget, and it was great. Yeah, it's a good one. Are you planning on coming to the foundations training this afternoon? That's where I'll go over how to like write up buyer broker agreements, listing agreements, things like that. If not, I'm not offended. It's okay if you're not. Okay, nice. Yep, well, 1 p.m. I'll be in the Gary Keller room. And we'll just go over some agreements and you can pretty much ask whatever questions you have about documents, things like that. Okay, all yours, Jake. Easy.
Do I need to am I standing in front of the camera?
Yeah, probably just because
Preferably?
we're recording,
Okay.
recording it for Zoom, so.
Okay. I was just gonna say, well, you guys don't have to feel public.
Yeah.
Well-
Just because we're,
So, like you said, super informal. I threw a bunch of stuff in here and I was kind of just gonna go through and see what caught your eye and what you wanted to know about. So you mentioned 2-1 buy downs. That's something I actually have in here. So we can look at that. You guys already know me, so you don't need my info there. Some of the quick topics that are going to be in here. I didn't put the 2-1 buy down in here, but comparing lenders, brokers versus like banks or Guild Mortgage and how they differ. Pre-approval versus pre-qualification is something I have in here. Basically just a lot of the simple stuff that I like to go over with either newer agents or especially first-time home buyers when I'm talking to them about what they're preparing for and what to expect, things like that. Do any of those catch your eye more than others? How about you, Brittany?
The 0 down.
Okay.
And grants.
Okay. Cool.
yeah, just for my own personal, just because I want to buy a house eventually. The 0 down sounds great.
Okay.
Or minimum down.
Cool. Yeah. So I can touch on that a little bit more. I'll explain what might be out there and then I will give you, so for me, when I'm talking about those programs, they sound really awesome surface level, but I like to give you more of my opinion on them and the more realistic view of those types of programs too. So I'll just kind of cruise through these pretty quickly. I always encourage people to shop around, whether it's with just another company or if it's a preferred lender of a builder. Shopping around is going to make sure you get the best deal. Personally, I think, and I'm a little biased probably, brokers are probably going to give you a better deal than some of the banks and the retail shops out there. So when I say retail, that's what we're going to get into in this. Retail is usually something between like a broker and a bank loan officer. So it's going to be your Guild Mortgages, your Cross Country, Security National upstairs. They're considered a retail lending company. Basically what that means is that they have pretty much everything in-house, similar to like a bank would, but they're only doing mortgages. So they're going to have your processing team, your underwriting team, everything they need to take the loan from A to B. Whereas a broker, we're independent and we kind of are just the facilitator. So I would say this probably isn't 100% true, but most of the time your brokers are probably going to have more experience than a bank or retail loan officer. Not always, but the reason I say that is because I've done both. And I personally didn't make the switch over to being a broker until later on in my career. And that's because I felt comfortable with my knowledge on loans. I knew what I was doing more. So to me, I didn't need all of the extra stuff to make sure I could do a loan smoothly and accurately for somebody. So what that allowed me to do is be able to offer more competitive loans and pricing and things like that.
So do you as a broker
have access to more or different loan products?
More potentially different, absolutely. The reason for that is because I'm registered with about 25 different lending companies. I don't use all of them, but some of them have a little more niche programs. But I can do just about everything any other loan officer could. I just don't do it all under one roof, if that makes sense. Yeah. So there are going to be certain, like talking zero down stuff, there's going to be certain programs where as a broker, I'm not able to get approved for doing some of them, where a retail shop might. But those aren't very common. There's only, I think, one specifically that I can think of that would be the case, but otherwise, yeah, I can do pretty much everything a regular loan officer could, like a bank or one of these other shops. Do you guys know about the difference between pre-qualification and pre-approval? Enough? Do you want me to cover it a little bit? Okay. So this is probably more of an opinion as well, but to me, a pre-qualification is I spoke to you either in person or on the phone, but I don't have any of your exact financial information or any of your other details. You're kind of verbally telling me, okay, this is what my finances kind of look like. I think my credit's here. This is what I think my debts look like. What do you think I could approve for? So I probably get this question the most often, especially with newer agents, because they're trying to, I think they're trying to figure things out both for them and the clients a lot, which is fine. I'm personally like that as well. I want to know everything so that I can feel like I can communicate it better. But what I'd say is it's a little tougher to do that, especially if you've got somebody who's trying to get out and shop right now. I know they want to get, they want you to give them as much as possible without them having to commit to anything as well. So I get that. And I'm always happy to do those, but I will stress when I do them that this is not like any sort of commitment to your approval odds or to financing. So if you go out and make an offer, it may or may not work out. Whereas a pre-approval, we're going through the whole thing, application, getting income documents in, I'm reviewing everything, putting together a presentation like you saw, Stacy. That's when I'll actually give a pre-approval letter. I try my very best not to give a pre-approval letter unless we've got some sort of commitment from the client.
When do you pull credit? Is it the application process? Getting the pre-approval?
So yes, I do the soft pull when I can. If somebody's like ready to get out and make offers right now, which happens too, then I'll have that conversation with them about doing a hard pull, just because we're gonna have to do it anyways. So soft pulls, we like to do those mostly as a courtesy. But if we can, we want to do the hard pull simply because it costs us money each time we pull credit. And so if we can minimize the amount of times we're doing that, it helps. Right. But if somebody's very adamant and they just want a soft pull done, we can do that and do a pre-approval based on a soft pull. Good question though. Yeah.
Interesting.
Any other questions on those? Okay. Yeah.
As far as what they're approved for, do you find that's the range is very similar between the lenders and situation? There's much variance there.
I would say if you're talking about a bank or a credit union, then yes, it could vary. Some of that's to do with them not having certain programs available to them, or they might have overlays on things where it has to meet their criteria and not necessarily the loan guidelines, if that makes sense. If it's between me and a retail person like Guild or Security National, it should be pretty close. Some of that's going to depend on your loan officer and their experience and how creative they are. So you can get a little bit of variance there depending on who you're talking to. It shouldn't be drastic if their income is pretty straightforward, I would say. If you're getting somebody who's like a business owner or makes a ton in commission or bonuses, sometimes those can be a little trickier, but yeah, is that? That's a long way of answering your question, but
That was good.
okay.
Does it make it harder when someone is, well, obviously, if they're like a business owner, right,
Mhm.
it makes it a little bit trickier as far as figuring out their steady income, right?
Yeah.
But, for example, I have a W-2 with a couple of companies, but I
Okay.
also 1099 for a few different companies.
Okay.
What would that process look like? Makes it real tricky.
It does. So when we have multiple sources of income like that, whether they're 1099 or W-2, the key is how long you've been doing it. So 1099 specifically, it's typically 2 years because you're a business owner as a 1099 person. That's me. That's what I am too. So the W-2 stuff, that kind of depends on if it's full-time or part-time and how long you've been doing it. The tricky part is if you want to try to use all of the income, or if you need all of that income to qualify. If you've got multiple jobs or multiple income sources, the guidelines tell us that you have to do those all at the same time for 2 years consecutively. So if you have like 3 part-time jobs or something, to count all the income, you'd want to be working all 3 of them for at least 2 years. So we see that a lot too, where, yeah, we see that a lot too, where somebody will just go and get a second job to try to help them because they think it'll help them. And then they're applying for a mortgage 3 months later, and we can't use the income to qualify, obviously, right? But it would help, assuming they could find something that works for them with their other income, it would obviously help offset some expenses, but
Well, that same scenario, but W-2. So I'm thinking more
Mhm.
like the first time home buyer situation where they
Mhm.
wanna beef up their lending.
okay,
So I have multiple jobs, you mean?
Yeah, so if they took on an additional part-time job.
it's the same either way, yeah. So you just want to, the length of the employment is what matters. Like even if you're working 2 full-time jobs, if you hadn't been working both of them for 2 years at the same time, we could only count one, and we default to whichever one gives you more income. So, good question though. And income can be tricky, and so that's a really good reason to get somebody pre-approved right there, is even if seems like a straightforward income, a lot of times there's some more nuances to it. Like for example, I got a very young couple pre-approved right now, that was in that same situation where the bank told them that they were approved at X just based on whatever they put in online. Whether you're young or old, most people feel like they know what they make or what their finances are, but when we put pen to paper and figure it out, it's usually a little bit different. And so they were out shopping at, I don't even remember what it was, like 350,000. And realistically, we could only get them approved for like 275. So had they gotten under contract based on what the bank told them they're pre-approved for, they would have got into a sticky situation. So
What if you, so let's go with the 1099 person. All of a sudden they're doing more business and so the income changes like drastically.
on the 1099,
Yeah. Would that, like, even if it's like, oh, they're making a lot more money, is that gonna hurt them because it's not seen as steady? You know what I'm saying?
no, if you start making more money, it would only help you. But it doesn't offset the length of time you've been doing it. So
Right.
even if you're making $1 million a year, 1099, but you're still in your first 6 months, you know, we can't count it to qualify. I know that example is extreme and you'd probably be able to buy a house anyways, but yeah, even if somebody's like, yeah, but my income increased like by, $100,000 because I switched to this. There might be some unconventional ways of finding something that could work for them potentially, but typically you're gonna want to be doing that for a longer period of time. Yep. Good questions. So that actually leads me to a thought about switching from W-2 to 1099.
I will take all thoughts, yes.
So it's kind of along those same lines. Even if you're making a lot more money, you switch from W-2 to 1099, it resets your clock. So you'd have to do, is
Okay,
that
that's
you?
great to know.
Is that you?
Well,
Kinda?
I do, so I do 1099 for most of the transaction work that I do here at the brokerage.
Yeah,
But I was talking to Nobly and I was like, I think I really should just switch to W-2, but it restarts it.
if you go the other way, it's not it. If you go 1099 to W-2, you're fine.
Fantastic. Oh, great.
If you go W-2 to 1099,
See what you're saying.
then it's different, because then you become a business owner,
Yeah, yeah, yeah.
and then they want to see 2 years.
1099 W-2, good.
No, bad. Other way.
Other,
1099, no, you said it right, 1099 to W-2, good.
good. I guess in my head, I'm remembering W-2 feels more stable.
It is.
It's gonna be a regular paycheck, okay.
It's more
That makes sense.
predictable.
What
Yeah.
if I've been working under the 1099, maybe for multiple companies or like different people, right? But I've been working under that 1099 for multiple years.
That's fine.
Really?
Yes.
This is looking up for me. This is
Yeah.
great. Okay, cool. Fantastic.
Yeah,
Good job, Jane.
there's lots of tricky scenarios. The key is getting somebody, whether it's you or somebody else, to the point where they are willing to let me look at it. If they're a salaried employee making 150,000 a year, like that's pretty easy to figure out, and somebody probably knows what their finances look like, at least income wise at that point. But if there's any little tricky things to it, whether it's 1099 income or they've got a rental or whatever, it's not as simple as like, well, I rent it out for 2,000 a month, so that means I can count 2,000 for my income or whatever. So just something to think about as you're talking to clients or thinking about for yourself. Like maybe I think my income's straightforward, but when it comes to a mortgage, maybe it's not so straightforward. Okay, so I threw in a handful of loan programs in here. You can tell me if you want me to go through any of them in very much detail. Conventional loans. How do you feel about conventional loans?
My question with conventional is,
Mhm.
when does a PMI cease to exist? Is it once they get that 20% threshold on their principal?
It's a good question. So obviously with conventional, we know that 20% down is like the standard or the gold standard, we'll say, because that gets rid of your PMI. If you don't, and you put 3 or 5 or 10 or whatever it is down, then it's kind of that way. It's not, as soon as you hit 20% equity, it falls off. There's kind of a little buffer there. So the PMI is ran through a third-party company for these conventional loans. There's a bunch of them out there, and they're all going to have different guidelines on this stuff. But typically it's once you're at 22% equity. It's really random. I don't know why it's that way, unless you refinance or communicate with them prior to that. But if you're just making your monthly payments and you pay it down enough to where you get to 22% equity, it will fall off on its own.
Okay, so it's based on the dollar amount towards your principal, sorry.
It's all right.
Versus a certain length of time. for the PMI on the conventional.
Yeah, so if we're talking about just making the payments to get there, it's always based on what the value of the home was when you bought it. And then as compared to what the 20% or 22% threshold is after you've been making your payments. If you're putting the minimum down like 3 or 5%, you're probably looking at around 8 years-ish for it to fall off on its own. So a lot of times you're gonna see the equity increase prior to that, to a point where you probably have enough. And you may consider refinance to get out of it. Which is very common, especially once rates start coming down. We'll see that a lot, where we've had enough appreciation over the last 2 or 3 years or whatever it is to get there. So we'll take the combination of getting a lower interest rate and removing the PMI, and it helps out the payment quite a bit.
What do you mean when you say fall off? Are we talking about the PMI?
PMI, yeah.
Now, why would somebody choose the conventional while still paying PMI versus getting a lower interest rate with the FHA?
It's a good question. It's a good question. So depending on the person's credit profile, the PMI could be lower on a conventional option. The tricky thing is FHA has a set number that PMI is, like a set percentage, and it depends on whether you put the minimum down, which is 3.5, or if you put 10% down or more. Or sorry, it's 5% down or more, not 10%. So the tricky thing is that people that have 5+% down might always want to go conventional anyways. But it just kind of depends on if their credit's in a good spot or not. Because if you go conventional and your credit is pretty low, while you might be able to qualify for it and do, whatever the down payment is and have the PMI fall off, if your credit's not great, the PMI becomes a pretty big burden on a conventional loan. It can be 3, 4, 5 times as much as an FHA loan would be, just because the credit's not great. So I guess the answer is it depends on that. But if it's somebody who's a really good credit profile, and they fit within the conventional box, I probably tell them to go that way, just because you do have the option for it to fall off. Or with a conventional loan, let's say you don't want to refinance or wait for it to fall off, and you've got this big boost in equity over the last year or two. You can reach out to the servicing company, and they will help coordinate with the PMI company to do an appraisal on the home, which you would pay for, but you can get the PMI removed that way as well. So if you've got the equity, you can call them up and say, hey, I'm pretty sure I got the equity. How do I get this PMI removed early? And there would probably be like a processing fee, and then you pay for an appraisal, and assuming you have the value, they will remove it for you.
What if there's somebody, they do have good credit,
Mm-hmm.
they have, let's just say over that 5%
Sure.
down, even closer to 10, case might be. They want the FHA rate, can they choose or elect to do the FHA?
Sure. Yeah. So the pros and cons versus the two. So I do a lot of FHA business. I know there's some lenders out there that don't, but I just think it's because and for whatever reason, there's negativity around them. And sometimes that can be the case with an appraisal stuff, but I present both options usually, regardless of your credit, just so that you can see what one versus the other might look like. The big thing that stands out as a negative for the FHA, if we're talking the same type of credit profile, is their upfront mortgage insurance premium. So I call it a funding fee because it's easier to understand that way. But basically, as a government-backed program, they charge a one-time upfront fee that's usually thousands of dollars. It doesn't come directly out of your pocket, but it gets tacked into your loan from the start. So let's say you are putting 3.5% down on an FHA loan. Their fee is a percentage. It's 1.75% of your loan amount that goes back into the base loan amount to start out with. So essentially half of your down payment is getting added back into the loan to start out with. So that would be like the biggest negative in my opinion, comparing the two. Is you start out with less equity essentially on an FHA loan. But your rate's gonna be 0.75% better usually. The PMI might be a little more manageable than you would find on your conventional loan. So.
Would you see, but you would, as far as monthly payments go?
Mhm.
it's gonna be higher.
No, actually, right now, at least, it's probably in most cases a little bit lower. Mhm. In most cases, depending, so like if we're talking somebody who has like a 780 credit score and we're
Mhm.
comparing a 3% conventional versus a 3.5% FHA. The mortgage insurance is gonna be lower on a conventional loan, which would probably help make up the difference in the rate. So then you might see the conventional be lower, but it's either very similar or a little bit lower on an FHA loan right now.
But still with conventional, obviously, we're that payment is going to your.
With an FHA loan, it would be because the lower rate.
Thinking
Yeah,
and offset that, but yeah, so
yeah, the mortgage insurance is like a separate thing from like the actual loan payment. Yeah, so your mortgage insurance doesn't apply to the loan at all. It's just honestly, it's something that you pay for that protects the lender. Because you're a higher risk for not putting more down.
Remind me, at the beginning of a conventional loan, you're paying more of the interest off at the beginning of the loan.
I mean, that's the case with any loan, but if you're comparing FHA to conventional, knowing FHA has a lower interest rate, then you would be paying more towards principal on an FHA loan. Yeah. Lots of good stuff. FHA loans, another reason why I like them, especially right now with first time buyers and affordability problems. If somebody wants this house, but they, can only afford this house on a conventional loan, we might look at FHA as an option because they're more lenient on their debt ratios. So that's another bonus with FHA if we're getting to a spot where we're at the top of a budget. So. Any other questions on those two specifically? No? Okay. I threw VA in here. I work with what I feel like is a good amount of VA borrowers, but as agents, you may or may not. These are very similar to an FHA loan as far as like the guidelines and the appraisal stuff. These also get a bad name because occasionally there's some weird things that can happen with an appraisal, but I don't want to get too far into the weeds with it, but realistically, the bad things that can happen on this rarely do. I've been doing this, gosh, 10 years now, and I can probably count on one hand the amount of times a VA appraisal has messed up a deal, or maybe not completely messed it up, but made us have to go like a different route with it. But they're great because they're zero down for the veteran. There's no PMI on them. They could have an upfront funding fee, kind of like the FHA loan, but if there's any sort of service related disability for a veteran, they waive that funding fee. These have typically similar rates, if not better than FHA. So all around, they're an awesome loan program if you can find a veteran. And yeah,
Yeah,
exactly.
we have a VA loan.
Yeah.
Yeah, when they did I guess it would fall under the inspection or appraisal, private appraisal. We have an RV pad.
Okay.
It was so far off the ground. They literally, like, I don't even know how you can measure it. They were saying it's like 2 inches too tall, so it needed a railing. on
Oh,
it.
really?
Yeah. Luckily, my
Well-
agent that I was working with, her husband does that, so he can
Yeah.
help me pull
Oh,
it in.
that's
Yeah.
nice.
And honestly, that's more like a safety hazard. So you might even run into something like that on a conventional loan. So if it's safety related, you can even have stuff like that come up conventional. So, but that's awesome, yeah. Your agent was on the ball with that one. Love it. Any questions from you about VA loans or any other things that you thought of on your specific house that you bought? I think they're great, VA loans.
I guess I just need to marry a veteran.
Well, hey, there you go.
Or maybe I'll get it.
Get your zero down, no
Exactly.
PMI.
Just an incredible rate.
Yep. Okay, and then USDA loans. Have you heard of those types of loans before? Yeah, so these ones are very, very finicky. We'll say that, that's the word I'm gonna use. They're for a specific person, specific buyer, and they have to, the house has to fall in an area that works for USDA, which seems to be getting farther and farther out, as the Wasatch Front grows, but
Mean like on the outskirts of where people are living, is that what we're talking about?
kinda, they
Okay.
have to deem it rural, and I don't know how they do that, but for right now, for us, anything south of Payson is south, and then like closer to the lake. I know there's a couple smaller towns, but so anything south of Payson. Eagle Mountain used to be good, like all of it, but now it's just like farther deep into Eagle Mountain that you have to go. Cedar Fort, that type of place. Grantsville. So Tooele itself isn't anymore. It's getting too big, yeah, so they're pushing it out, and then if you're going north, I think it's north of Ogden.
It's Tremont County.
Tremont still is. I don't think Logan is, because it's a bigger city. But places like Tremont and what's the other one? It starts with a B up there. Brigham City, yep. So those little places up there are all rural. But yeah, outside of the house itself qualifying, it can be very tricky if you don't know what you're doing on these. You can get into a lot of trouble as you get into a contract with them. All of their stuff is pretty much surrounding income. So with a USDA loan, it's zero down. But because of that, they're very particular about who they're gonna qualify. They don't want you to make too much money, essentially. And that's not just you as a person going on the loan. It's anybody in the household that's of working age. So that's where we run into issues. So their income guidelines vary depending on how many people are gonna be living in the house and the county that it's located in.
So
So
let's say that I bought,
Mhm.
I could qualify for it, if I had a roommate that obviously has their own job. That could mess it up.
It could. If you had a 16-year-old that was of working age, so 16 would be, I think, what they consider the working age. If they aren't working, we have to prove that they aren't. Or if they are, even if it's a little part-time gig, we would have to get all of their documents in to add into it's because it's household income that they look at, so. That's why I say if you don't know what you're doing on these, you can get into trouble pretty quickly. And the other thing is that their debt ratios are a lot more strict on this program. So it's kind of weird because they don't want you to make too much money. But in today's market, to meet the ratios, you kind of need to make some money,
Yeah.
right?
Yeah.
So
Very narrow margin.
yeah.
Yeah.
So I don't do these a ton anymore. Probably 4 or 5 years ago, when there was more rural places, when they weren't so strict on where you could buy and rates were better, obviously. I did a ton of these. But now I probably do a couple a year. So either way though, I'm very versed on these loans and I know what I'm doing. So if you find somebody that wants to shop for something like this, yeah, let me know. That way you don't get into a tricky situation. Any other questions on this one? Okay. Cool. So down payment assistance and grants, bunch of them out there. And they're a great way for people to get into a house. Here's where I enter my opinion, they're not always the greatest option. If it's your only option, then let's do it. But most of the time, they're gonna be down payment assistance, which means it's like a second loan of some sort that you're either paying back monthly or at the end of, or when you refinance or sell the home, you might have to pay it back. There's a handful of true grants out there where you don't ever have to pay them back. But typically they're few and far between, and the only one I can think of right now, well, there's two, and they're specific to military and police officers. And that's through Utah Housing. Are you familiar with Utah Housing? Okay. So there's
What's your-
I've done a ton of them, but it's usually for people where that's kind of their only option. If I tell people all the time, like if you have a way of getting a down payment, whether that's on your own, your 401k, getting it gifted from a family or friend, if you can do that, you're gonna like the loan so much better. For a couple of reasons. The interest rate, we have very little control over when it's Utah Housing. So whatever they post their rates to be, that's what they are.
Can you lock it on a rate?
Yeah, you can lock the rate. You have to be farther along in the process with Utah Housing to lock a rate usually. They want you to have like an underwriting conditional approval on your loan. A lot of times to do that. But because the rates are gonna be higher than market rate, and you have, unless you're getting one of their grants, you're gonna have that second loan that's covering your down payment. So monthly payments are usually $200-300 higher on Utah Housing. So if I'm presenting that option to somebody, I'm very clear on that, saying, just so you know, like maybe you're already concerned about monthly payments. If we go this route, it's gonna be even worse, right? You're gonna be $200-300 higher. And if they're like, okay, I still wanna see it, then I'll put it together and send it to them. But if they're payment sensitive, like most people are these days, we might try to go another route or get more creative. So, the two I get the most questions on usually outside of Utah Housing are, well, one of them is the Utah Housing program. It's their $20,000 thing for new builds. They call it a grant. It's just a silent second loan where you're not paying monthly. But whenever you sell, you have to pay however much you took back. So you're still kind of starting off negative equity in the home with those. So as long as everybody's on the same page with that, great. Now there's one in Salt Lake area called NeighborWorks. This is the program that I don't have access to. But Security National would, if you have somebody that wants to look at it. I think that one's up to 40,000 that you can get towards down payment and closing costs. I'm pretty sure it's one of those grants where you pay it back. And the same thing with the Provo City one. I think theirs is very similar to the NeighborWorks. I can do that one. But theirs is up to 40,000 as well. And I want to say it might be forgiven after a certain period of time. But I'd have to go double check on that one.
That was the one I was gonna have a question on.
It's,
That
yeah, is he using that?
on his condo.
Oh, he had it on the condo.
Yes, he just told me, yes, that he's selling, he just mentioned it yesterday.
Oh.
to me.
Oops.
And so I was like,
Well, hopefully you have enough equity still.
we should.
I can
So
look-
had more questions.
I can look at it and see, I can't remember if it's forgiven after a certain period of time or not. It might decrease in the amount you have to pay back over a period of time. I don't know the ins and outs of it that well off the top of my head, but
Apparently it could be used in other cities other than just Provo. Is that like?
Really?
Well, it's in Springville.
And he said it was the Provo City grant? I don't know, maybe at the time when he got it, they were being more lenient on it, but as far as I know, you have to buy within Provo City.
Okay.
Yeah. So there's a lot of those like that where Provo Cities is the most aggressive with the 40,000. But there's one in Ogden that's similar. If you buy within Ogden city limits, I think they give you like 10,000. But it's the same thing. It's silent second loan, you know, that they're labeling as a grant. So that's a lot of what they are sometimes. And
Would that help with even the purchasing power? So for instance, they're approved for 225. They got a $20,000 grant that help bump them.
maybe, so the thing you gotta be careful with is, the people that sponsor these grants, kind of know that there's gonna be people trying to work the system, so to speak. And they may not allow you to combine your whatever amount you have, your 40,000 plus their 20,000 to make it work. So, it's kind of just case by case, and it could potentially help the buying power a little bit. But I know because I was trying to do one of the Owen and Ogden options, last month. They denied my borrower because he had too much assets. So that's kind of what I'm talking about, where,
This would not be the case. It's just
Okay.
simply to be able to, 'cause there's nothing in that price range.
Sure, sure.
So it was literally like.
Yeah.
I'd find
The-
something.
so it could potentially, does this person that you're talking about have a down payment already? Like a 3.5% or maybe?
Not quite 3.
Okay, so they could probably combine it and it might help their buying power just a touch. Like maybe, I don't know, 5 to 10,000 more, if that makes a difference. So potentially. Try anything, I guess, right? Does my biased opinion on these help you guys understand them a little better? They can be great. I don't wanna make them sound so negative. I just like to make sure people know what they're getting into with them. So,
Perfect, thank you.
yep. Okay, so this one is talking about what I can do to approve, increase qualifications and or affordability. So a few of the ideas I came up with are having a legal ADU rental in the property and using the rent from that to increase your qualifications and your affordability. So maybe you already qualify, but you're a first time buyer or a family that doesn't want as high of a payment. Having somebody rent out like a basement apartment would help, you know, cover the mortgage.
If you did that, but without a legal ADU, but you have roommates living into them.
So-
Would that offset it all, or does it have to be a legal ADU?
To from the start to count it, it would have to be a legal ADU. What you're talking about is something called border income. So essentially roommates, but you're not gonna be able to count that from the start. So that might be like if you were down the road trying to refinance it and so for some reason at the time you didn't qualify to refinance it, but you've been collecting rent from roommates. So long as you've been reporting it on taxes and have like a lease agreement with them, you can count that income at that point. But I usually want to see it reported on taxes at least for a year for border income. Good question though, but it does help affordability. So I know, you guys know Ivan? He's trying to do something like that, where he's not gonna qualify using it, but get some roommates to help him afford the place. Adding a cosigner is something I will suggest pretty frequently to people.
Is that a cosigner just on the loan or on the actual purchase of the home? Like where they go on. title?
Both,
Okay.
yeah. I guess they can elect not to go on title, but if I'm a co-signer, I wanna be on the title of that house. Cause if the other person does decide to stop being responsible. And I'm in charge of the payment, I also wanna be in charge of the asset. But co-signers, I see them a ton. It happens all the time, especially with younger first-time buyers. Usually the biggest concern is A, get me off that as quick as possible. Like refinance and get me off as quick as possible, but B, how is this gonna impact me if I'm trying to buy a house in the next 12 months or qualify for another type of big purchase? And so the way that works is they'll still remain, like if you're not refinancing them off, they'll still remain on the loan and on the title. But if the main buyer makes the payment each month out of their own account, and we can prove that happened for at least 12 months, that debt doesn't count against the co-signer for when they're trying to approve for something. Does that make sense? So that's something that a lot of people don't know. And it can help ease the mind of a co-signer too. So if we get into that situation, for me, if I can, I like to be able to talk to the co-signer and answer the questions and make them feel better about it. Any other questions on the co-signer? No? Okay. Try to get creative on other income sources that the buyer may not mention outright. So Social Security, any type of pension, child support and alimony are a big one that most of the time doesn't get mentioned. So if I'm looking at an application and it appears they might have something like that, I will ask. So that can be a good way for it to kind of put us over the top on qualifications. Child support and alimony specifically, they have to have been receiving it for a certain period of time before we can use it. So that's one thing we look out for. But morning.
Production coaching?
Yeah.
Yes, okay.
What's your name?
I'm Alex.
Alex, I'm Jake, man. We were texting last night. Good to meet you. Okay, so gift funds is another way to help with bridging the gap on a down payment or closing costs as well. This one's very common too. Usually a semi-wealthy, responsible adult that gifts them money. So grandma or parents are usually the people doing that. Do you want me to go into any specifics on gift funds? You guys feel like you're okay on that? Okay. Obviously, we can talk to them about improving their credit. So either they don't qualify because of credit and we get them to where they can, or maybe if we can get them to the next tier of credit, it might give them a slightly better rate that can help with qualifications. So that's something we look at. And then something that you were talking about earlier is the rate buy down. So you've got temporary and permanent. And I've actually got a lot more detail on those two things if we care to dive into them. How do you guys feel about your knowledge on temporary and permanent rate buy downs? You feel good? How about you two? Shaky? Okay. Let's jump into it. You probably learned a lot more about them recently, right?
Yeah.
Because of Sean. So there's a ton of different options for a temporary rate buy down, meaning various lengths of time you can do it. The two most common that I've seen are the 2-1 buy down and the 1-0 buy down. And essentially what that means is you're paying money up front. When I say you, it's probably the seller that's paying the money up front to have your rate temporarily lower in years 1 and 2. Following me so far? How they're structured is they only work if somebody else is paying for it, meaning the buyer is not. In fact, I don't think that a lender will let the buyer pay for it, because all you're doing is taking your own money and putting it to the side to pay for the payment you're going to pay anyway. So it has to be a seller or a lender that covers it. You're almost never going to see a lender cover it, so that leaves one other person. So it's gotta be the seller or the builder that's gonna cover the buy down. So the way that it works is whatever the buy down cost is, let's say it's $10,000 to do this temporary rate buy down. They take the money from the seller and they put that in an escrow account. And the escrow account is there to supplement your mortgage payment. So I'll show you an example here in a second, but we'll just say the mortgage payment is 2% low. We'll do a 2-1 buy down. So it's 2% lower in the first year of your mortgage, 1% lower in the second year. So what that means is we'll say that the payment in the first year is $600 lower than what it normally would be because of your temporary rate buy down. So you're paying the $600 less. The other $600 is coming from that escrow account that the seller gave you money for. So you're combining the two and making the full mortgage payment as a supplement. Does that make sense? So that's kind of how they work, and that's why it has to be a specific party that pays for them, for it to make sense. So here's kind of the quick example. I don't know how well you can see that, but this is based on, so just doing kind of simple math, $600,000 home, 10% down. I picked a 7% rate. They're actually going to be a little lower than that right now, but it kind of shows you the difference there in what the payment would be year over year. So this red column here at $3,593 would be your normal payment without the buy down. With the buy down, you can see it's closer to $2,900. So that does give you about $600-700 less on your payment. So you can't qualify based on the lower rate, so it doesn't help with getting you more purchasing power, but it could help with affordability, at least in the short term. So where this could be beneficial is maybe a first-time buyer or somebody who knows they're going to be getting a big promotion, or maybe it's somebody in the medical field who knows that their income is going to increase pretty substantially over the next couple of years, something like that. So that's kind of one of the big benefits of it, is temporary affordability while we wait for rates to come down or for the person to make more income. That makes sense? Any questions, Alex?
No.
Okay, cool. So I was kind of touching on some of the benefits. Another one that a lot of people don't get mentioned to them if they're doing a temporary rate buy down is what happens to that money in that escrow account if I refinance before the 2-year period. So it is your money. It's just sitting in an escrow account that you can't access outside of making your mortgage payment. If you refinance, let's say in the first 6 to 12 months, there's still going to be a big chunk of money in that escrow account that was supposed to go towards your monthly payments. Because it is your money, it will get given back to you in one of two ways when you refinance. So it's either, the most common is that they're going to take and reduce your principal mortgage balance with whatever's in there, so that you're refinancing for less. The other one that sometimes happens is that they'll cut you a check at closing or after closing, wherever the difference is. So either way, you're getting the money back in some way, shape, or form. And that way it'll help you kind of feel better about the costs of a refinance. So that's a pretty cool thing that most people don't know about, are the rate buy downs.
If they are refinanced, can they do that again with the rate buy down? And then that money's still sitting there in escrow.
Like get another rate buy down on their money.
I theoretically, yes, but that's not a question I've ever asked before. No, that's a good question. I don't know if you would do that, but is it an option? Maybe. That's one for me to find out. It could make sense, yeah, if you're just using that to cover whatever the rate buy down would be. At that point, you're not having your principal balance lowered, and you're still rolling in the costs of your refinance typically to the new loan. But if you're fine with that, while still getting a temporary rate buy down on the refinance, theoretically, I think it works. Yeah,
Awesome.
yeah, I mean, I don't see why you couldn't do it, but there might be some lender guidelines on that won't allow you to on a refinance. Can look at it, but. Any other questions on these benefits here? Or other thoughts on it? I like that. You make me think, give me some homework.
So when, in a purchase contract, when the seller offers concessions, right?
Mhm.
Trying to remember the contract, but at that point, the buyer can elect to use those concessions for a rate buy down, right?
Or, yeah,
They don't need any other kind of approval or anything like that.
They shouldn't,
to be
no.
used at their discretion.
they shouldn't, I guess there could be a lender out there that wants it spelled out that way on like an addendum.
Yeah.
So that would be kind of more of an inconvenience, but yeah, you can use it for whatever you want other than a down payment. Yep. Some drawbacks too. It's not all roses, unfortunately. You will have higher payments in later years, so if you're not prepared for that, that could be a potential issue. The cost of it is a lot. Now typically that's not going to be a concern of the buyer because somebody else is going to pay for it. I guess where it could be an issue is if they want to buy down and the seller isn't willing to. That then they might not be able to come to an agreement, and you may not buy the house if the seller is unwilling to help out with that. Do you have a question or a comment?
Like, what if kind of worked an agreement where increased the purchase price?
Mhm.
So that put money in the seller's pocket
Yeah,
and then they pay.
that's a great way to do it. So a lot of people will ask me if they can finance closing costs or things like that, and the answer is no. But you can in a roundabout way, which is that you increase the purchase price to get money back from the seller. And so in that sense, you are financing your closing costs just in a way that meets the loan guidelines. So you can do that. I would just suggest making sure that you're very confident that the house will appraise for however much you're raising it. That would be my only suggestion there, but that's a great solution for trying to get closing costs for a buyer covered from the seller. So it's not going to be a long-term solution, obviously. It's at most probably a 3-year solution. Because you can do what's called a 3-2-1 buy down, which is for 3 years. You have the rate bought down versus a 2-1 buy down, which is for 2 years. By the way, those are less common because they're super expensive. You need like 20 grand for a 3-2-1 buy down. But yeah, not a long-term solution. So the idea is that as soon as it makes sense to refinance, you can get down to a rate that makes sense. Do it so that you don't have to worry about the big payment later. And then this one's another big one. The rates may not come down like everybody's anticipating. I did a bunch of these 18 months ago, and the rates are still about where they were. Right. So that is a risk. One of these days we're going to be right when we say this, but I do think that rates should come down in the next 24 months. My opinion on it, if you care to know, is that there's trillions of dollars in credit card debt. That's a big thing that nobody talks about. So people are going to need an outlet somewhere, which is probably cash out refinancing. So that's one reason I think rates will come down. But another big one is job loss. It may seem like the economy's cranking based on what we hear, but I follow it pretty closely, and lots of people are losing their jobs, businesses are shutting down. And so to me, that's another big indicator that our country's biggest cost on a day-to-day basis is housing, whether that's rent or mortgage. So something's got to give, right? So I think we're pretty close to a breaking point, in my opinion, on that. My crystal ball might be fuzzy, but I think we'll see it sooner rather than later. So this could still be a really good option, temporary buy down. If you don't want to bet on the market like that, but you can still get some closing costs, permanent rate buy down could be the solution. So same type of idea in a way, but you're just buying the rate down, not as much, but it'll be permanent. So say if you can get that $10,000 still, but you don't want to do a temporary rate buy down, you can put all of that towards a permanent rate buy down. It just would probably only get your rate down maybe somewhere between 1/4 and 0.5%. So not the 2% that you're seeing on a 2-1 buy down for the first year, but you'll know that it's fixed at that point and you don't have to worry about it jumping up in the next couple of years.
Sellers have to pay for that one as well.
No, they don't have to. In fact, buyers pay for permanent buy downs on their own all the time. Right now, I strongly advise people not to, because I believe the rates are going to come down. So to me, it doesn't make sense to pay thousands of extra dollars to have your payment $80 lower, when there's a good chance that in 24 months or less, you're going to refinance and incur more costs to refinance. So you don't want to pay twice, in my opinion. So if somebody's adamant on it and they want to do it, then it's their loan and their money, so they can do it. But I will advise them not to, and if they're working with me. It's a good question though. I love when sellers cover all that stuff. That's my favorite, because we can get super aggressive on rates and options.
What's the limit again for how much a seller can like how much in concessions they can give?
It depends on the loan program and how much you're putting down. So FHA is 6% across the board, regardless of how much you're putting down. Conventional, it depends on the down payment. So I think 3% is where they start, 3% of the purchase price. So all these are based on the purchase price. I believe as you hit 10% down, conventional goes up to either 4 or 5%. I'll double check on those for you and let you know. But as you get to like the 20 and 25% down, like conventional, you can get up to 9% in concessions from a seller if they're willing to do it. So where that comes into play typically is if you're buying $1 million homes and people are willing to concede that to get their home off the market. So I've personally never done one with 9% in concessions, but I have seen a bunch with 6%. So yeah, it's going to range anywhere from 3 to 9% in concessions, depending on the loan program. Good question. Yeah. Any other questions on a permanent buy down? This one's a little more straightforward. I guess this kind of gives you a little bit more information on questions I already answered. And the question that I touched on was, how much does it buy my rate down? And usually it's not as much as you might think when you're putting up thousands of dollars to do it. So what I like to show, I think it's this next slide here, is when I'm talking to somebody about if they want to spend their own money to do a buy down, we want to look at where your break-even point is. And so what I mean by that is, let's say in this example, you're doing one discount point. So if you've heard the term points or discount points, that's a percentage, and it's based on the loan amount. So in this example, if we do 1 point on a $450,000 loan, that's $4,500. And I did this, I think last week, so the rates might look a little different now, but it bought it down 1/4% and changed the payment by $110, which would take somebody almost 3.5 years to recover the cost of, if you're looking at the $4,500 divided by the monthly savings. And so If you're one of those people that think the rates aren't gonna change in the next 3.5 years and you're not gonna refinance, then maybe that does make sense. But if you're like me and think it's gonna be a lot sooner, then it probably wouldn't make sense to spend your own money to get the rate 0.25% lower. Any questions on that? Okay. Is that it? That might be the end of my slides. I thought I had more in there, but maybe not. That's all I
Great.
got.
Amazing.
Anything I didn't cover that you guys have questions on? Any buyer specific that you're working with now, people that you're running into weird scenarios with? No.
Great, thank you.
I hope it was. Hopefully it was helpful.
I learned a lot, so I'm ready to go buy a house finally.
One question I did have, if I have to buy a car now, how far is that gonna set me back to be able to qualify for
I don't know, 'cause I don't know your finances, but
a fair?
it could, I always tell people if we're worried about qualifying, hang tight on making a big purchase,
Mhm.
if you can. If your engine might blow up and you need a car